Okay, we're going to do a video here on volatility and what it is and how to trade it. Now, there's two sides to the story on volatility. A lot of volatility or no volatility. And both are the same. I mean, they're two obviously different concepts, but you need to know how to trade both. So as day traders or, swing traders, we're looking for volatility in the markets. But we don't want to trade extreme, well, we can trade extreme volatility. I mean, that's where you make huge money for sure. But you also, the risk is commensurate with that volatility. This is a stock ATOM that we traded yesterday, and it had yesterday a huge move, which we'll talk about in a second. But there's two parts to volatility. One is quite often associated with the float, how much stock is available to trade. The lower the float, the higher the volatility. Generally, that's the case. As there's no supply, and if there's big demand, then you get extreme amounts of volatility. But let's just quickly talk about ATOM here first, and no volatility. I mean, this is not a stock that we would be looking to trade, to day trade, really. It just never trades. I mean, here, traded 9.35 is the low, 9.60 is the high. It's a 25-cent move. That you can't trade, you can, but it's very difficult to trade those because your timing has to be absolutely correct. And again, from a swing trade point of view, if you took a trade in here on the stock and it consolidates, for 4 or 5 months, you're tying up capital that you can't use. You're caught in a trade there's just no volatility to it. There's no trend. So you can't trade. So you can't day trade or you can't swing trade this type of stock. I don't know how many shares are outstanding, but this is probably a lot of stock. But it never trades, so you can see there's no volatility to it. There's no impetus. But then when we get this huge volume spike and we get this big move yesterday. Now this is we want to talk about this part of the trade. Here, and we had huge spreads on this stock. It was very difficult to buy. And quite often you see that it's not so obvious in this chart, but where you get these big long wicks on the bottom and the top of the candles, that's usually an indicator of big wide spreads. And I'll see if I can find a stock that has those type of candles on it. And that's where you get the big wide spreads, and it's very difficult to trade it. So the question was, how do you trade this? Well, on this stock yesterday, when I took the trade, I was looking at I think this was the one, I was looking for a pullback entry op on it. And what I did was, it was right around the $20 level here. I bought it. This was the first pullback in here. And I bought it here. No, that's not it where I bought. I think maybe I bought it in here, yeah. So it popped, flagged, and when it started to trade in this area, I took a position, but it was very volatile. We can see just in a minute, traded 40 cents. Here, this one traded 70 cents, in this 2-minute candle. That's quite often indicative of a widespread stock where they had these big swings in it here. Not so much on a pop, but just when it's consolidating, you get these big swings. How do you trade that? Well, what you have to do in these kind of situations is you can't chase it. You don't want to buy it on the offer. I mean, if it has a 20-cent spread on it, 30-cent spread, if you buy it on the offer, all of a sudden you're down 30 cents before the trade even starts. It's too dangerous. So what I did was I picked a level. I said, okay, 20 is going to hold, or it's going to be an area. I'll put in a bid there. I'll know what my stop is, but I have to give the stop a lot of room. And in this case, I probably gave it 50 cents. 19 and a half. And so I put it in at 20. I got filled, and fortunately it went in my direction. I mean, our thesis was correct. It's in a rising channel, so we would expect it to continue on. If I had broken the channel, then I would have had to get out, and I would have probably taken a pretty good kiss on it. So having said that, I didn't have a big position in it. I just took a small piece relative to the size of the portfolio. Because if it goes against you, you're for sure you're going to get whipped. You're going to get badly whipped because there's big spreads, and your ability to get out is you're going to have to hit the bid, and it's going to be a long ways down there. So you just take a small piece. But it was like 1990 by 1930 or by 2030 or something like that, and 20 by $20 by $20.30, $20.40. So I just put in my bid at 20. It was 1990 by 1930. I got filled at the 20, and then it took off, and away it went. And then what I did is I just joined the offer when I wanted to sell, and it worked its way up, and I got out of the trade. So in those situations, you have a thesis. Now the thing about putting in a bid, you may or may not get it, and quite often you don't get it, and that's okay. You just miss the trade, but you don't want to rush into these things and be bidding it up, or hitting or taking the offer out, buying on the offer on a huge spread, because if your thesis is not quite correct and it goes against you, you're really going to get hammered. So in the case of these high volatility trades, you have to just go on the bid or miss the trade. You can't chase them. So that's and in this case we saw, this is the low volatility. These we don't trade. It's not even worth looking at these stocks like this. There's no trading. People are asking me all the time in the market, what about this stock? What about that stock? If there's no volatility to it, it's not of interest to us. Now let's have a look at another one. This is a good indicator on. You can see this stock never traded. Well, I shouldn't say that trade. Well, back in here it never traded, but you get these big long spikes in here. You see these big long spikes, and that's quite often an indicator that there's that's high volatility, or low. It's a low float stock, and so you get high volatility. These SPACs have been like that, huge volatility, big spreads on them, very, very difficult to trade, and you can see that here by these long wicks. These kind of, you get these big long wicks on them. In here, it never traded. The volume dried right up, took off, and you get these big whippy candles. Look at this SPE, same thing. This is high volatility. How do you trade that? And probably big spreads. So you have to, when you get these kind of trades, you just have to go on the bid in hopes you get filled, and hope you get filled at the right time. Because if you chase this, imagine you're chasing this here to 37.42, and 4 minutes later it's dropped $1.50, and you haven't really got a chance to get out because the bids, the offers are so wide apart. So the trick about trading high volatility stocks like this is A, your entry has to be right. B, you just go on the bid in hopes you get filled. And if you miss it, then you just leave the trade alone. You don't chase it. That's how you trade these stocks.